Welcome to Coleman Report Live. I'm Bob Coleman. We're talking Main Street and the small business lenders who help it grow. Mike Grossman, it's been a while. Good to see you.
Good to see you, Bob. Thanks for having me on.
And Katie, of course. Good to see you, Katie. What does Mike Grossman do? What is Bowfly doing these days? Give me a Bowfly one-on-one.
Sure.
I have no idea who you are and what this good-looking guy does.
Sure. For those lenders that are on, primarily we help you source business borrowers that you otherwise wouldn't meet. Particularly in the franchise space, we have a meaningful relationship with national franchisors, and it's our job to make sure their franchisees can find the right lenders, whether it be SBA or conventional. So, and if you want to take a look at Bowfly, you can access the platform where, out of deference to our friend Bob, we're going to be waiving fees for his listeners, and it's a way for you to try out Bowfly and see.
Well, go ahead.
Yeah, so it's typically $150 a month, and we'll waive the first 3 months of fees. For those that reference Coleman, and it's a way for you to source transactions you wouldn't otherwise get.
So how much is the commission on 3 free months?
We'll have to work on that, Bob. We'll have to work on that. Yeah.
3 times. Hey, take advantage of that. Mike does good stuff. Mike, you've been around for a while, and you've always had your fingers in that IT space, the fintech space. Tell me what you're doing fintech-wise that's interesting.
Yeah, sure. So one of the things that we spent a lot of time on, Bob, is thinking about how franchisors grow. And we built a technology that we call Verify, which allows that franchise brand to assess a franchise applicant very efficiently. We're pulling liquidity, net worth, credit, criminal right up front. And that becomes really important for the lender, because by the time we match up that franchisee seeking financing with their lending partner, we've got a substantive amount of information, not just self-disclosed, but from trusted third parties, including bank statements, criminal credit, and a lot of details. So we're working with some great national brands, like Sonic, Senior Helpers. We're starting to work with Dunkin' Donuts. So there's brands out there that you lenders have been lending to, and it's a way for you to access that franchisee you otherwise may not have had at your discretion.
Mike, what percentage of your transactions are in the SBA world?
Oh, I'd probably say about 90%, Bob.
Yeah.
We are expanding in conventional. What we're finding is that, and we had an interesting experience recently, we helped a franchisee acquire their first Checkers location. We matched them up with SBA lending. They were busy building out their portfolio. Now they're at the point they've outgrown SBA. They don't qualify for it anymore. And we're matching them up with conventional financing now. So we want to deliver value to that customer throughout their life cycle, both at SBA, but also as they mature out too.
Good for you. Well, this brings up our first question, which is, which industry has the strongest franchisor support for its franchisees? Restaurant, hotel, gym / massage parlors, not parlors, I guess what, massage, I'll let it go out there, contracting home repair. I don't know the answer. We'll see what the audience says, and then Mike, I'll let you take a crack at it. They say 42% restaurant, 51% hotel has the strongest support.
Yeah, I think it's reasonable to see hotels and restaurant as leading the charge. I have to say, and actually I recently spent time with the folks at Hand and Stone, which is a massage and facial concept, and they lavish their franchisees with support, right? So I think it's going to depend upon which franchisor you're assessing, and so I think that's going to overwhelmingly make a big difference.
Good, yeah. And that's what, not all franchisors are the same, and that's the takeaway I want Mike to drive home is there are some very, very good brands out there, and there are some brands that don't quite meet expectations. Is that fair enough?
It is, and actually I think one of the big drivers that we look at, Bob, and you guys have always been, I think, leading the charge in the industry about making sure there's measurable data out there. So one of the things that we get from, we look at from Coleman is the historical default rate and the charge-off rate, right? And that becomes incredibly important. What it becomes very obvious to see is that those brands who support their franchisees have a lower default rate, lower charge-off rate than those brands that leave their franchisees on their own.
And there are those brands that make a commitment. They can't put it in writing, but they'll make a verbal commitment to the lender, to Bowfly, to say, hey, if there's an issue, we'll do whatever we can, turn over rocks to get another franchisor in there and support them. Right, Mike?
I think that's exactly right. And from time to time, and we've looked at this on the conventional side, is we've actually been able to put together programs in place. There was a large national brand who wanted to get access to capital to their franchisees, and we actually put in place a guarantee program between the franchisor and the lender. That was outside of SBA.
Right.
But that's entirely indicative of what we're talking about. There's franchisors who will provide great support, including, in rare situations, guaranteeing loans. Now, that's going to create complexity and other issues along the way, but it shows that there are franchisors who will take a very active role.
Mike, would you agree with the statement? I would say the franchise industry has grown up. Back in the 80s and 90s, they just wanted to sell locations and get that franchise fee and move on down the road. Today, it's matured into, hey, if we take care of these people, we give them all the support we can, we're going to make more money than selling new franchises.
For sure. There are, so absolutely, one of the big things I'd point to is the private equity world has come in a major way over the last 10 years into franchising, and that's continued to accelerate. And if you give me a private equity investor, they understand they're looking for long-term recurring fee structures. That means keeping that franchisee open, not just booking the franchise fee. However, there are terrible franchise brands that are out there in the market that, as long as the individual can fog a mirror and write a check, they're going to let that franchisee in the system. The brands that we work with are diligently assessing the franchise applicant's financial wherewithal, and we would strongly encourage any franchise lender or SBA lender to be mindful of the fact they've got to look at how the brand diligences their franchisees.
Just look at the charge-off and the delinquency report. I mean, that's,
absolutely. But you're right. But Bob, I think you have right. The industry has grown up a lot, and there are those drivers as to why maybe it's private equity. But they, I think, meaningfully have improved over the last number of years.
Poll question number 2. Katie, don't worry, I'll get you in. Katie's very patient. A POP 7A lender loan can be made to a company with a loss in 2020. True, false, or what's Coleman talking about? Very good. The answer is true. And we're going to be talking about that in a couple of weeks with our webinar on that. Katie, I'll let you jump in here real quick. Well, the number one item that Okram was saying in the call yesterday was this issue in terms of how to calculate cash flow and projections, correct?
Yeah, that along with training. So those both kill two birds with one stone, really, is they're focusing on cash flow. They did have a good, decent portion of the webinar yesterday where they discussed how to really look at cash flow when you've got that 2020 situation. Obviously, 2020 was not a good representation of how, and the SBA understands that historical cash flow is not only not enough really just on its own to establish whether these businesses are going to continue to grow. And if you've looked at just 2020, some of these businesses might look like they're not doing as well. So of course they're saying combine that with a good projection and you really then are going to see a better picture of the business, and that's going to help reduce losses in the future.
I mean, they made it very clear. They said, we all understand historical cash flow does not repay loans, Mike.
That's I think every lender learned that on within the first week, right? Ultimately,
your first bad loan. Why'd this loan go bad?
It's a learning experience. That's right.
Well, you know what they say, a good lender has good experience. And do you know where you get good experience?
From bad loans.
From bad judgment. How do you get that? From bad loans, so bad experience. So good judgment is a learned trait. Katie, what else do we have on this slide that's of interest? You wrote about that this morning. We talked about it yesterday. What other main points do we want to focus upon?
Yeah, so this is mainly focusing on things that Okram said. They had a nice representative who went through all of this. And we did go over it yesterday on the show as well, but this is a great way to summarize it, especially if you didn't catch the show yesterday. Okram's top concern, like I said, is training. The other concerns they're focusing on are software, internal controls, and LSP agreements. Obviously, those are all things we've discussed previously as things they focus on, and none of that should be really a surprise to anyone. The
Mike,
second point, oh, go ahead.
No, go ahead. Finish your thought. I thought you were finished. Please finish.
Yeah. The second point was that quick closings are the biggest red flag right now on SBA loans. Okram's also watching debt refinancing, loans sold before being fully dispersed, and business acquisition structures. So those are all things to really watch out for on your loans because they are looking at that. Also, they're prioritizing the review of they have been prioritizing the review of SBA Form 159. However, beginning this month, they're going to be shifting that emphasis toward reviewing Form 1050. So that's something to be aware of.
Yeah, they want to know. They want to know what's going on with settling. Hey, Mike, I haven't talked about this before, but I know a big push by the regulators. Treasury hit this is the interaction that the lender has with a third-party vendor. How have you changed your business model to address that issue? Is it even a problem for you?
Well, so I think as a software on demand, it becomes less of a problem, right? I know we've shared this before, Bob, and we're always happy to disclose that we are owned by a regulated bank. And so we sold 2 years ago to approximately $10 billion bank. We're a wholly owned subsidiary. We run separately. However, needless to say, Bowfly thinks about security in the same way that the banks do, right? Because we are in fact regulated in the same way. I think vendor management has become a headline issue at our bank partners and beyond. And we are prepared to answer questions that bankers have around this. But I can confidently say we put a meaningful amount of capital to make sure that we continue to hit those requirements, Bob. And I think it's very important for banks to ask their other partners those same questions too.
Yeah, and in terms of security, I mean, everyone knows what's going on in the news on that. Another round of, hey, let's make sure that working virtually and in-house and third-party vendors, that's a security nightmare. And I know that that's going to be a huge topic in the short term for lenders and making sure we're protecting the borrower and we're not subject to bad actors. So I know you are on the cutting edge of that. Last poll question, and then we're going to go to something else. Rental moratoriums. Rental moratoriums, this is for commercial real estate, negatively impact the value of that commercial real estate, doesn't affect the value at all, are a concern but a temporary glitch in the valuation process. Temporary glitch and negatively impact. This is my question. This came up yesterday. Is one of the concerns SBA has is they want to make sure that we are evaluating stuff, whether it's a business or real estate, correctly. And I put this question in there is don't forget, what is the value of real estate? Well, it's the value of the real estate as any other investment is how much cash does that generate? You're going to evaluate that commercial real estate, that hotel, in Mike's case, based on its cash flow. It doesn't make any difference how much it costs to construct or how much it costs, comparisons. They're going to look at restaurants. They're going to look at freestanding restaurants. They're going to look at hotels based on the cash that's being thrown off. So remember, these are business loans. These are not real estate loans. So that's why I focus upon that. Mike, is that pretty well how lenders are treating your transactions? Yeah,
I think that tracks, Bob. And certainly on the underwriting standpoint, and your question earlier, which highlighted the impact of cash flows in 2020, we understand that all really well. Now, a lot of our clients did actually exceedingly well in 2020.
Well,
Restaurants with drive-throughs did exceedingly well. Quick service restaurants did fantastic. Now, they also had to work their tails off to make adjustments for sure. But look, it's ultimately, banks, one thing banks always understand very well, my experience is, they know how to underwrite. They know how to look at those cash flows, but cash flow is what's going to pay your loan back.
Yeah, absolutely. And that's why I bring that up is so when you have vacancies, if you have a vacant building with no tenant, it's not worth anything. Now, true, we have a projection of someone moving in there, but be careful. Don't be careful of that. Are we going to be able to attract a new tenant? Southern California, I know there's a move now. They're taking these zombie malls and they're making it easier to rezone to build condos, which I think is a great solution. So anyway, so be aware. It's cash flow. We're looking. We're looking at the number of keys, and I know there's a price per key based on the brand, and that's a nice place to start. But we want to see what the underlying value is. Hey, Katie, what is the GAO telling SBA to do?
Yeah, so there's a GAO report that came out June 2nd, which basically is a summary of GAO recommendations. It's giving the SBA administrator an idea of what's still open and what needs to be addressed. Currently, there are 15 priority recommendations and a total of 54 just general open recommendations. Focusing on those 15 open recommendations, they fall into four categories, with the by far the largest being the COVID-19 pandemic response. Then you also have disaster response, credit elsewhere, and then export promotion. Diving into those a little bit, the pandemic response, I'm not going to go through all of them. They're generally able to be summarized pretty easily as they want the SBA to identify and respond to risks in both PPP and EIDL. They want them to create an oversight plan for both of those programs, and then they want to continue to monitor potential fraud risks within those. And of course, there's multiple steps they're going to have to take for that, but generally that is what they want to do. They're saying in a very general form. So far, the SBA administrator has not disagreed with any of those recommendations, and it sounds like they'll probably get implemented. It depends on whether the GAO sees it as fitting, whether the administrator has completely fulfilled that, but it is pretty broad after all. But I do think they are going to be addressing that very strongly, especially in the coming months.
And remember,
looking at disaster. Oh, sorry. Go ahead.
No, you finish. I keep on cutting you off. Please, Katie, finish.
Looking at disaster response, they really only had 2 points there. They want to identify and document risks associated with disaster response, and then identify the key elements of a disaster action plan. So in the future, if there's something like this ever again, hopefully there's not, but if there is, the SBA would be able to respond quickly and handle that with disaster programs that are fitting and work properly. Under credit elsewhere requirement, the SBA is being recommended that they do more on-site and off-site reviews to collect information on lenders' use of the credit elsewhere criteria, and that's the information that they have on lenders to determine whether there's a greater risk of non-compliance with certain lenders. So those are the two recommendations there. And finally, export. I know that's not a huge deal for our lenders on the call, especially what recommendations they have, but generally they're saying create a better plan for additional international trade staff for the SBA, things like that. It's not as much on the lender side for those recommendations.
My two comments are, you got to love the government. What's the difference between a priority recommendation and a priority open recommendation?
So they have just general open recommendations, and then they have priority recommendations. So the 15 priority recommendations are among the general open. So of the, 54 open recommendations, 15 of them are a high priority that they want to be handled quickly.
GAO, maybe you can go high priority, medium priority, low priority. Anyway, the last comment is, so credit elsewhere is on the list. The reason why that's there, and I'll finish the show with this, is Congress continually asks SBA are you doing your mission? Your mission is to serve underserved markets. Your mission is to get capital to Main Street for fills the gap of loans that lenders would not get. And Mike, I'll let you have the last word on that. How do you handle the credit elsewhere issue when you're representing your franchisees to lenders?
Look, it will always be a headline issue for SBA lending as long as there's delegated authority and lenders are going to be responsible for taking these decisions themselves. It's a main question. Does this business borrower have access to capital elsewhere and under commensurate terms and support? And so in our work, Bob, you can show up with a overcapitalized individual who's getting into startup financing. Now, they may not be able to get capital elsewhere because I don't want to do, the conventional lenders don't want to do a startup loan, but now it gets into the personal resource test as well. So these issues get overlapped.
Please don't say personal resource test. We don't want that back.
But those are the questions that lenders have to answer. But certainly I'll say we know historically we're able to represent to the lenders of, was there conventional out there for this borrower or not? And is it appropriate to get them SBA financing?
Hey, Mike, I appreciate you coming on talking about franchising. You're our go-to person for that, so thank you very much.
Thanks, Bob. Appreciate you having me on.
I know you're busy. Let's get you in here at least once a month and tell us open up our eyes for franchising.
That's
Katie,
great.
thank you. Our webinar starts in a half an hour. Hop on, send Joseph an email, joseph@colemanreport.com, and talk about past due. Lance will be doing that. And thank you for joining us today for Coleman Report Live and for supporting America's franchise entrepreneurs, one loan at a time.
Have a great day.